Hey Bulls and Bears, today we're going to discuss the big, beautiful tax bill that was just passed, or is it a big, ugly tax bill? We'll get into that. Target is reporting falling sales. We're going to talk about what's behind that. It's actually a combination of factors and a lot of other recent developments, financial, economic news to get caught up on. Please make sure you are subscribed, and let's go ahead and get started right here. All right, folks, let's go ahead and go through this. This is going to be a very brief summary, kind of a bullet pointed edition of this big, beautiful tax bill, which I think is more ugly than beautiful. Here's a summary though. Extension of the tax cuts makes permanent individual and estate tax cuts enacted in 2017. It's making them permanent until someone else comes along and reverses it, of course. Increase standard deduction. Temporarily increases the standard deduction by $1,000 for individuals and $2,000 for married couples through 2028. No taxes on tips and overtime. That's the big part of it that I think a lot of people are liking. Of course, if you work for tips and you work overtime, you can see how paying taxes could really take the life out of you or make you less motivated to want to work in general. That eliminates taxes on tips and overtime through 2028. Why not make that permanent? I don't understand that. Car loan interest deduction allows a deduction for interest on car loans through U.S. made vehicles. That's part of the Make America or Made in America push that we're seeing out of this administration. I actually agree with that. So it allows for an interest deduction on vehicles made in the U.S. Increased child tax credit temporarily increases the child tax credit to $2,500 through 2028. Increased SALT deduction cap raises the deduction limit for state and local taxes, the SALT, to $40,000. Savings account creates tax advantage savings accounts for children with a one-time federal contribution. So they're going to deposit the first $1,000 into that account. And it goes on here. I've got some AI generated results here. It's 1,000 pages, folks. I mean, we can't go through it all here. The bottom line is, sure, there's some good parts of it. But what are we doing? Are we spending less or are we spending more? Well, there's spending cuts involved in this, but we're actually spending more. It's still spending, folks. We're not actually cutting. It's a cut to the amount we're spending, right? That's why they're saying it's cuts, but it's actually still spending. In other words, one day you go to the amusement park, maybe the fair, depending on what you like, depending on what's going on. You go out to a place, you spend $500. The next day you're going to say, I'm going to cut spending. I'm going to go to the same amusement park, spend $450. Folks, you still spend $450 at the amusement park or fair, whatever, the mall, the rummage sale, who cares, right? It's just whatever. Doesn't matter. You cut spending, but it's still spending. Do you guys understand this? This is not a big money saver. In fact, the debt's still exploding higher as we speak. So what bothers me is not that this is happening, because it's been happening for decades, but the fact that they're trying to make it sound like it's something that's really going to help people. Now, the couple things I did mention I agree with. That may help people, some people getting tips. Obviously, people making overtime, you don't want to get taxed on that. But the big picture, the larger scheme of things, it's not going to make a impactful difference in this entire economic structure. All right, and some of you may agree with me, you may disagree, you may not even care. But what I like to say and explain to people is this: we need major structural change. We don't need just fiddling with the current system or figuring out who gets tax cuts, who doesn't. Yes, some things in here will help people a little bit, but again, in the big picture of things, it's not going to make an impactful difference to make someone in poverty become wealthy, or make someone living paycheck to paycheck get out of living paycheck to paycheck, or get ahead, right? A little bit maybe, but not an impactful difference in my opinion. I mean, this is what I'm seeing out of this. Please let me know what you think down in the comments. Agree, disagree, either way. Also, I should add, this means that it just moves on now to the Senate, where maybe it won't pass. So this may not even pass, folks. So we're going to see how it plays out. There's, of course, a left versus right divide on this bill. and it only passed by one vote. The vote was 215 to 214, so it barely passed. So it's going to be interesting to keep an eye on that, and of course we'll give you updates as things evolve on that particular bill and how it may affect people. But actually, before we move on here, one thing to mention is that even people on the right were describing this as a big debt bomb. How they put it over at Mediaite. House Republican shreds the big beautiful bill as a Titanic level debt bomb, and some have highlighted that this is actually going to affect the ultra wealthy more than it's going to help the little person, or it's going to benefit the ultra wealthy more than it's going to benefit the little person. They call it a cynical giveaway to the ultra wealthy that guts federal health and nutrition programs, which is true. I mean, we've already seen that. We've seen the nutritional programs. Food banks are out there warning of shortages and talking about they need now people to donate. They're trying to get more people to donate because the federal cuts, right? So it's going to be very interesting in this country to see how the people that are barely scraping by get through this. And who knows, myself or many people right now watching this that are not currently barely getting by, maybe we'll be barely getting by when this thing plays out. I hope not, but I always like to prepare for the worst. My wife calls me a doom and gloomer, kind of like some people on this channel, they call it down in comments. I always like to prepare for the worst, folks. So, doom and gloom, whatever you want to call it. I call it preparation, preparing. If you've ever worn a seatbelt, then I guess you're a doom and gloomer because you're preparing for an accident, or you're preparing not to get a ticket because it's the law that you have to wear the seatbelt. Either way, folks, let's move on here, and a couple other things I want to get into today. We have a U.S. bond sell-off happening, and these are the countries that hold U.S. debt. Well, they're now selling off that debt, causing bond yields and rates to rise on namely the 10-year and the 30-year Treasury. Let's go ahead and take a look at a chart here. All right, let's start off with the 10-year chart here. We're up to a high that's the highest that we've seen, going all the way back to about 2000. I'd say about 2007, 2008. 2007. So pretty interesting on the 10-year. And the 30-year, the highest going back, going all the way back here to also 2007. So pretty interesting on these Treasury yields. And what's happening is these countries are questioning the solvency of the U.S. and questioning the strength of the dollar because they see all the spending. They see the chaos, pretty much the tariffs, and all the uncertainty out there has the investment community selling off the debt, and that's causing rates to rise. And it's not just the yields, it's also interest rates on mortgages and other borrowing mechanisms are likely to rise as well. All right, people, let's move on here. Let's move on to some retail-related news. And what are we seeing at one of the biggest retailers? I was going to say the biggest, but that would be Walmart. Target, they're up there. They're amongst the biggest, one of the biggest. Target sales plummet amid tariffs, inflation, and boycotts. They had a situation with the DEI products. I don't remember. I don't think we've ever cut that. We've ever covered that, but I think you guys might remember some of that detail on that. But this is Target, folks, and their sales is declining by a small amount, but nonetheless, it's declining. And the expectation was a small rise in sales, but instead they're seeing a decline. So it's very interesting. Companies always look at growth and profit growth from quarter to quarter, but now we're seeing not just a drop in growth, but actually a decline. And here's how they describe it over at USA Today. Big box retailer Target results showcase the pressure American consumers are under. In May, consumer sentiment slumped further while one-year inflation expectations surged, and that's going to go up even more based on what we're seeing in the bond market. Still, Target's forecast contrasts with bigger rival Walmart, which maintained its annual forecast. Basically, Walmart came out and said they're just going to raise prices. Of course, they had some pushback out of the administration. The administration came out telling Walmart, you better eat the tariffs or eat the cost of the tariffs. All right, so think about that. First, we were told that the tariffs was not going to be passed along to the consumer. And then when a big retailer, in this case Walmart, came out and said, yes, it will increase cost, then they had to go and the administration had to go push back against Walmart. So first it wasn't going to cause price increases. And then when it was announced that it would, then they just pushed against the retailer that came out and said that. But back to Target here. Basically, this is going to be up to Target. I mean, will they raise the prices or not? Will they be scared to because they might get pushback from this administration? Right? It's going to be an interesting thing to see how many retailers have to talk about raising prices and then maybe back off doing that. Also, moreover, on Target, the first quarter comparable sales fell 3.8%, and that's much bigger drop than estimates, which were about a 1.08% decline. Target reported $1.30 per share earnings. Analysts had expected about $1.61 per share earnings. So these are far below expectations, to say the least. Now, as far as investing goes, I don't hold any Target stock. I had it a long time ago. Decided to get out of most retail stocks several years ago. One of the retail stocks I'm holding now, I hold a few. I mean, if you want to count Starbucks, I don't really call that retail because it's food and drink, but technically it is. But one stock that I'm holding that I've talked about here is Dollar Tree. I thought Dollar Tree was really going to do good, especially amongst high cost of living and high inflation. But it hasn't been a very good investment over the past few years. I've had it for over 5 years. It dropped a lot, actually. I mean, if you look at the highs, it dropped from about $172 down to about $71. It's starting to creep up a little bit. We're back up to almost $90 now. And I just wanted to put that out there because that was one of the stocks that didn't do good. But I've got more that have done really well versus bad. And if you've watched me on this channel, you see that from time to time I'll give you some things that I'm investing in, and it doesn't mean they're always going to be winners. I'm going to share the losers with you as well. But I expect the Dollar Tree to do very good, especially when the 99-cent store went out of business. I figured there would be a surge of people shopping at Dollar Tree to make up for the loss of the 99-cent store. Obviously, that wasn't the case. The stock still dropped, but that was my kind of my thinking going into it, where I took kind of a large position in that stock. But we'll let you know on the winners, the losers, the good, the bad, and the ugly, everything in between as far as my investing goes. All right, moving on here, folks. Let's talk about real estate, the housing market, and also rentals, which is the biggest portion of someone's income is their housing costs, right? So we try to touch on that every report, every episode. Couple things here. We've got home sales just plunged, folks, to the lowest since 2009. That's a big drop. We're all the way back to 2009. And if you thought this was bad, 2009 is a long time ago. If you thought this was bad, it's about ready to get worse. And it's likely about ready to get a lot worse because this bond sell-off has it's going to put upward pressure on mortgage rates, definitely. Home sales fell in April as consumers face high housing prices, obviously, and growing concern over economy and employment. Home sales have been 75% of normal or pre-pandemic activity for the past 3 years. Even with several million jobs added to the economy, the median price of existing homes sold in April was $414,000, an increase of 1.8% year over year. Now, keep in mind, most of the major news outlets report data out of Redfin or the Association of Realtors. We look at the Federal Reserve numbers, and those Federal Reserve numbers actually have the median home price down about $20,000 from the all-time high. Why do I like to look at the Federal Reserve numbers instead of Realtor? Because it gives you a broader picture of sales across the United States, including smaller towns, not just the larger metropolitan areas. And on the topic of this housing market drop-off in sales, here's how Wolf Street put it there. Spring selling season fizzles, worst April for home sales since 2009. Supply has now surged to the highest since 2016, folks. So we're approaching a 10-year high in inventory. So for those waiting patiently for the housing market to start to correct and maybe see some more affordable housing, things are changing, they're turning, but probably too slow for most people. And for those not looking to buy or people that just rent, You may have some relief on the horizon as well. A little bit, not a lot. Rental affordability across the U.S. is showing a little bit of improvement here recently. According to Realtor, the April rent report, the data revealed that the typical household is using about 23.4% of their income that goes towards paying rent. And that's for the standard rental home. That's down from about 24.7% in April 2024. It's a little progress, right? Down from 24.7 to 23.4%. That's about a 1.3% improvement. Again, not anything hugely noticeable, but it is something that is indicating that things are moving in the right direction, even though, again, it's probably too slow for most people to really save anybody that's in a situation right now. But it's better than rents going up, right? And now, let's move on here, folks. Wells Fargo just came out and gave their opinion on it. We're going to talk about who and what. But basically, they're coming out and saying, and I'll bring up the headline, they're coming out and saying the tariffs will not lead to a resurgence of U.S. manufacturing jobs. Wells Fargo analyst. And I agree. What have we been saying right here on this channel? Why would companies want to close up shop and wherever they're located and bring jobs back to the U.S. when the cost of living here is so high that they're going to have to pay wages much greater than what they'll have to pay in the tariffs, right? So they'll have to pay more in the tariffs, but they're going to pass that along to the consumer, right? And if you don't believe that, then why is Walmart coming out and saying they're going to raise their prices? Why did the administration have to go against them and tell them not to do that, right? So we know now that the tariffs and the higher costs will be passed along to the consumer, or at least that's the plan, unless there's enough pushback to make the retailers think otherwise. But now we've got the wages that are too high here, and this can all be reversed in a few years with the next administration that comes in. So if you were a big company, if you were running the business, would you want to pack up shop from name your country and bring it to the U.S., knowing this all could be reversed, right? And knowing that you're going to get pushback if you raise prices enough to try to keep up with the higher costs here? I know if I was running a company, I wouldn't feel confident in making the move to come back to the U.S. And this is not an anti-American thing to say. This is just from a business standpoint. If you're in the business, would you feel comfortable coming to the U.S. with the political environment right now where every 4 years things can go 180 degrees in the opposite direction, and where you have to pay some of the highest wages in the world because the cost of living here is so high? And don't say, well, JJ, the U.S. is the world's richest nation. Everybody wants to come here. Sorry about that. Some music started playing on one of these screens I had open. So I think you know where it's going, folks. Also, I want to go on to this here. Cuts. Speaking of Walmart, right? They're cutting 1,500 corporate jobs. Walmart, who's not losing money. They're still making money. Profits are looking good. Still cutting jobs. 1,500 corporate jobs. The moral of that, folks, the moral of the story I want to say is, if you feel comfortable today and you have a job today, great. That's great. But keep this in mind. Companies are not keeping you there because they want to. They're keeping you there because they have to. If they can replace you with robotics, if they can replace you with AI, if they can just downsize and get rid of you, they're going to do it, folks. They're not keeping you there because they like you. They're keeping you there because they have to, and they have no alternative. But believe me, as soon as they're able to cut you out, they will. Now, it's interesting that 1,500 corporate jobs are being cut, and the retailer said cuts are being made to lower expenses, streamline decision making. So when you see that, we know that AI is used for a lot of decision making now. And you have to wonder, 1,500 jobs, I mean, why were those jobs there in the first place? So it tells me that there's some sort of automation going on for this many corporate job cuts to be happening all at once. All right, but let me read on here just to see what it says. Walmart CEO John Furner and the Global Chief Technology Officer Suresh Kumar said in a memo to employees recently that the company is reshaping teams in its global tech, and Walmart US organizations, where it has found opportunities to remove layers and complexity, speed up decision making, and help associates innovate rapidly. So why were those people there in the first place if they could just cut them out? Well, that tells me that there's some newer technology that is making it to where they can now cut these people. And is your job, is my job next to be cut from whoever your employer may be? And maybe you're self-employed and you don't have to worry about this, but you have to worry about your consumers being able to purchase your product even if you're self-employed. And what if a lot of your consumers are laid off? You know what I'm saying? Also, the U.S., we're cutting many of the financial regulators. Some people say that's a very good thing. We're cutting costs. Other people say it's going to be more deregulation in the financial system, which is going to make banks go even crazier, even wilder with the loaning out of money, with the interest rates, everything else, borrowing, everything from the way they're advertising to the yields and the annual percentage rates that they offer to depositors, and lots of things that regulators do. But this bond sell-off, folks, investors dumping bonds globally, is this going to turn into a route where rates are going to spike up even higher, maybe 8, 9, 10% mortgage rates, which is going to completely, the housing market's already imploding very slowly, but it's definitely going to speed up the housing market implosion if this were to happen, folks, with the rising rates and the dumping of these bonds in the U.S. debt. Please let me know. We're going to talk more about that in our next report. I've got to get some more details on it for you, where I think all this is headed. But let me know down in the comments what you think. And everybody, thanks for being here. Keep stacking. Bye for now. Peace.